Hello and welcome to today's profitable high probability trading session where we're looking to trade the US Open. My name's Tim and I'm one of the traders here at the live trade room. So we'll get into this session in just a moment. For those of you who are interested in genuinely learning how to trade these financial markets with a high degree of knowledge and understanding about the decisions that you ultimately take. Take responsibility for those decisions, of course, but do so within a kind of a framework, really, which is always quite important. Try to be consistent with your decision making. If it's a bit erratic and you're chopping and changing your approach and you're taking stuff on board and then you're getting rid of it a few days later, of course, it's very difficult to sort of establish yourself. Discipline with your capital as well. For us, and something we spend an awful lot of time working with our traders on is for our traders to understand how much capital they're committing to any particular trade. The reason for that is you trade within certain parameters. So, and that's really quite important, because if you oversize on a regular basis, all of a sudden, if you take a series of back-to-back losing trades, for example, which can happen, then you can experience a sizable chunk of your capital, and you can avoid all that by being a little bit more disciplined. And then patience as well. There's opportunities when let's say that there's certain market conditions when it's favorable for you to really be a little bit more patient and not be so anxious to be jumping in, and vice versa. There's often free flowing market conditions as well, which you would then be actually looking to be quite active. So if you do need support along these sorts of lines, do go to our website, www.thelivetraderoom.com, for more information, and do feel free to contact us through the chat function as well. We can sort of explain kind of what we can do for traders. So what will we do over the course of the next hour or two? We'll be trading the US Open. It looks like we've got a few very interesting markets, and it looks like they're setting up quite nicely. So we get into those in just a moment. But we'll go through the whole process necessary to be able to sit down in front of your trading screens and make hopefully well-informed trading decisions. And we trade markets like your foreign exchange, your commodities, and also global indices. So for us, it is important to have a multi-asset class view. So we don't just trade the foreign exchange markets. Okay, so without further ado, please take a brief moment to familiarize yourself with our risk warning currently up on screen. And please do give us a thumbs up or give us a like on this video. And do subscribe to our channel. We will be releasing a lot of content over the coming weeks and months, so you'll be notified whenever that content goes out there. And so the first thing we really do when we hit our trading desk really is to just be mindful of the major news events. We really want to understand if there's any major news events over the course of that trading session that's likely to impact our trading decision making. And what we can see from here, trading session. So what we can see from here is we've got very little major news events to have to deal with. I suppose the most important one is the fact that we've got another central banker, the governor of the RBA, due to speak, but later on this evening. And it's a speech titled "The Recovery, Investment and Monetary Policy," something that the wider markets really have a strong focus on at present. There is another sort of off-screen news event which you may want to be familiar with, and I'll just give you a little bit of context. If I can zoom in on this one here. So I've got off screen, I've got a list of US Treasury bond auction, and the reason why that's of importance this week is last week we saw a run in these markets. We saw the indices markets take a really significant turn to the downside. Now, of course, that all effectively happens for a specific reason, and there's certain drivers behind those moves. And the reason for that major move was the fact that bond yields were increasing. So it was actually a 7-year note that the US Treasury wanted to raise some capital. They issued a 7-year note, and the demand for that note was very, very poor, very underwhelming. What it led to was increase in bond yields. So they started to increase significantly. Now, there's a backdrop to these markets. We've got the US stimulus package in the process of being approved. What does that mean in real terms for us traders to be able to work with that bit of information? Because it is quite important. What it means is there's stimulus checks of $1,400 US. Going to every American in the US, and that's a sizable amount. That's I think the second largest stimulus package in human history, I believe. So it's quite a big deal. So it means more people have more money in their pockets. What does that then mean? They're likely to obviously spend more. So if people are ready and willing and able to spend more, what you generally see is prices increase as a result. So as demand increases, prices increase, and that will obviously lend itself towards inflation. Inflation is likely to drive stronger growth. The OECD came out with a report actually this morning saying that global growth is likely to we're likely to see a 1% growth in global growth over the course of this year. So quite significant. This stimulus package is likely to formulate a part of that understanding. Why is growth a concern? Why is extra stimulus a concern and spending? Why is the bond yields increasing? Why are all these things a concern for these financial markets? It always generally boils back down to interest rates and the Fed, central banks potentially needing to take a little bit of heat out of the economy, and they can do so by increasing interest rates. What's the problem with increasing interest rates? We've got debt-laden, not just economies, but also on the corporate side and personal debt as well. They're all at record levels, and if you increase interest rates, then of course the repayments start going up, and then you can have series of defaults and lots of other issues along those sorts of lines. So with this increased interest rate environment, we're seeing stocks roll over to the downside. So we're seeing that pressure being applied on the stock markets, especially after the growth that they've seen post-COVID. They've seen exponential growth to the upside, and now they're taking a little bit of a roll back to the downside. There is conditions that are still in favor of stock prices higher, so we'll want to keep an eye on that. There's a lot of talk about growth stocks, and those are stocks that have been suppressed for a prolonged period over the course of the last 12 months, and now will show some form of value, and we're likely to see traders piling into that. So what does it mean for us? Well, with the asset class that we trade, we can sort of benefit from this basic knowledge and understanding. We can look to buy or sell the equity markets, your major indices markets like the S&P, the Dow Jones, and the Nasdaq. It's correlated with the US dollar, so we'll have opportunities perhaps in dollar strength or weakness, depending on how these markets start to unfold. will have knock-on effects in terms of commodity prices. So we've got to take all these things into account. If the dollar becomes more expensive, then that can have a direct impact on commodity prices and demand for commodities. So all of these things are added to the melting pot of these current market conditions, with a really strong focus as far as the stock markets are concerned, and the indices. There is a very significant focus on bond yields. So last week we had the 7-year note, we had low demand, we had increasing bond yields. Stock markets took a very significant turn to the downside, and the dollar increased in value, and you'll see that across the charts. Now, the reason why I'm talking about these bond yields is because we've got 3 more auctions. So today we've got a 3-year note, US Treasury 3-year note. We've got a 10-year tomorrow and a 30-year on Thursday. And what the markets will be watching carefully is to see the demand for these bond auctions. So if we see a shock like we saw last week, where we saw an awful lot of volatility, we can now see if that's replicated again this week. We think it absolutely has the potential. We're still focusing on that dollar strength trade. There may be some opportunities actually currently in the pipeline that we'll have a look at in just a moment. But over the next 2 or 3 days, the markets are in a precarious position. So if the demand for these bond yields are lower, if demand for the bonds are lower and the yields start to increase to try and stimulate demand, then we can expect the stock markets to actually take another leg to the downside. And as a result, the dollar is likely to strengthen accordingly. So this is how we're positioning ourselves for these markets. We're quite heavy on the US dollar at the moment in terms of dollar strength. So we'll go through these markets in just a second, because believe it or not, today is a bit of we're having a bit of a reversal trade across the dollar pairs, but that's likely to present us with some interesting opportunities if we think there's still room for dollar strength. So that's what we'd be focusing on. Not really a huge amount of individual sort of news events to have to concern ourselves with today. It's really broadly the more macro environment that we're keeping a very close eye on. Okay, so every evening at 9 p.m. we have our live trade plan webinar, and we identify what we refer to as high probability trading opportunities. We don't trade every opportunity across every market. Whenever that market starts to move, we have a process by which we can narrow down our focus and look for obviously the trades that are likely to give us the best possible returns on those opportunities. So very, very quickly, if I just get up my pen, I'll share some very, very quick analysis with you across these dollar pair trades. So we can see that this is the euro dollar in here, and we look at it on the daily time frame in just a second. There's your monthly low. This is a strong level of support, which now becomes resistance. This market made a low yesterday, and now we have pulled back to that particular level. So if we anticipate this market to move in this fashion, then the next leg to the downside for the euro dollar, we would interpret that as looking at this as an opportunity to actually sell the euro dollar. So we'll have a look at this price action in just a moment, but very similar sort of analysis across these dollar pairs. Some of these levels we've seen the accelerated move to the upside in the dollar yen. We've now pulled back to a strong level. This is resistance up here, which now becomes support. So now we're looking to see if we get the conditions to get a buy trade off in the dollar yen. So actually, yes, the dollar is taking a bit of a pullback across the board. We can clearly see that that's the case. And now we're looking for levels of support and resistance. So we can see those in the euro dollar and the dollar yen, but we can't really see that just yet in the dollar Swiss trade. It's quite sharp sort of descent and we're kind of breaking out, as you can see, below the 50 period moving average. You'd want prices to sustain themselves around this type of level. Sorry, let me get up the pen. We're looking at these levels in here, so you'd want prices to show signs of slowing down, and as you can see, we're just breaking further lower. So now we look for highs on the way down. So I suppose there is an opportunity perhaps around these types of lows to also identify this as a level of resistance, which now can become support. The clarity is not great. This is an hourly chart, don't forget. So the next level really would be all the way kind of down here to this zone, the 91. Well, it's the 92 cent level. So that would mean this market would have to drop quite significantly to get in on this pullback. So we can certainly discount the dollar Swiss just for now, and just focus probably a little bit more on the euro dollar and the dollar yen. Looking at the New Zealand dollar, again, all of these trades we go through in quite some detail every evening at 9 o'clock in a live and fully interactive trading environment, so you'll be able to ask questions and things like that. And again, for more information, do just go to a website. It's just currently there up on screen. So look, what we can do with this market is we're looking for sort of major highs and lows in these markets, and we can see actually we are running into a level of potential resistance at these current levels. It's not cleanly defined, but we can say, give or take just a little bit, that this, for argument's sake, is a strong level of resistance. Now, we are making a case for that trade. So will we see this market actually continue what would then be consolidation until we get a breakout of these lows down here? So bit of a question mark over the New Zealand dollar. Let's see if we get stage one first. Let's see if we get prices squeezing lower, and it's certainly not clear cut. So for that reason, we can probably look to discount the dollar Swiss and the New Zealand dollar. They're just not in a good place just right now, but that of course can change pretty quickly. Gold is the next market that we discussed in some detail last night. And actually, we discussed it yesterday. If you look at this currently up on screen, we can get in on a pullback around the 1700. And that's really kind of where these prices are right now. So we spoke about that level yesterday. There's your strong level of support and resistance just in here, which supports prices from above until you get that breakout trade to the downside, and then that same level becomes resistance. So that's the basic principles of support and resistance. So we can expect a bit of downside, a bit of price action from these highs. So we can. It probably makes a little bit more sense to actually have more levels of support and resistance. These are all intraday levels, these ones, and we've got the monthly lows sitting in here. So we don't need to be too concise. We can look at this price action just in here and suggest anywhere in type of this inside this type of range is support from above and then becomes resistance from below. So when we're down at these lows, and if we're looking, what we can see from this trade is that we are firmly in a downtrend. So we've got a series of lower highs and lower lows as this market pushes lower. And the reason why that's important is we have no reason to doubt the nature of this next move, which is to the downside. And that's I suppose that's the mindset that needs to be adopted in order to get into these trend related moves. So we can absolutely look for some selling opportunities in this market to the downside. We will be notified when we get those 3-year US Treasury note auction results, and we'll see how those play out. And what we're looking for really, or what we anticipate is likely to be a bit of a problem for these markets, is if the demand is perhaps lower than anticipated. I think the 3-year, there's something like 58 billion. Forgive me if I'm mistaken with that figure, but it's a sizable figure. So if demand is healthy and we get that sort of mid $50 billion level, or 60 or above, then we can probably see that being quite supportive for the equity markets, and the dollar may continue its sell-off. It's just right now we're getting these interesting opportunities, these little pullback moves to strong levels of support and resistance, and that's what we can look to trade. So we just prepare our trade plan. So we've got the euro dollar to the downside, we've got the dollar yen to the upside, we've got the gold market to the downside. There's two more markets. Just have a quick look and see where we're at regarding these indices markets. To say it's choppy and volatile is kind of an understatement. We've got this sort of strange, not strange, but very erratic, very volatile series of, there's lower lows, but then there's also structural failure trades and higher highs from these previous levels. So it's a bit all over the place. A very easy way to identify the current market conditions in this market is to look at something like the daily time frame, and what we can do is we can throw a pretty significant blanket over this price action, and we're getting some really significant moves. If you look at the price action that we've seen in the build-up to this event, very mild, not too much volatility, and then you just get these wide, very significant ranging, market conditions that are just up and down and things like that. So there's still this bearish biasness to it, although today's price action is pushing higher. But there's a slight downward momentum to this trade, and that's what we think is likely to perhaps continue over the short term. So that's the equity markets. We're seeing this little pullback trade. It is just probably a little bit of profit taking from some of these sellers. We want to see, we're still below the monthly lows as far as the Nasdaq's concerned. We're firmly between the monthly highs and the monthly lows as far as the S&P. The Dow Jones we're very close to all-time highs again for the Dow Jones. That's its own sort of micro market at the moment compared to the other two indices markets. We're seeing further upside in the FTSE. The signal is not fantastic really for the FTSE markets. We're seeing we're getting quite close to this structural failure trade to the upside, and it just remains to be seen whether we get that opportunity or not. The DAX, we're off to all-time highs again for the German stock market, and then in Japan, the Nikkei is just finding a little bit of support again. At what level? When this market was pulling back and we were looking for previous levels of highs and lows, again, it's purely visual. This is your resistance preventing prices from pushing higher, and that same level becomes a potential level of support now that prices are above. So this is why hopefully this approach that we adopt, hopefully it makes some sense, because it is quite easy to see, and we just look for these levels of support and resistance over and over and over again, and then it's about the execution of that trade and the timing of it. So the opportunities can actually speak for themselves. We've got a bit of an up and down bit of price action, so we'd want to be sure that we get the other correlations on side if we're going to be buying the equities and the indices markets. Bitcoin, as you can see, we're getting quite close to all-time highs again. We're at sort of 53, 54,000 price point there. So we are getting this little sort of rollover bit of price action here in the euro. Whoops, excuse me. Let me bring that back up on the screen. So let's prepare these moves. Let's have a look at these in a lot more detail. Let's go down into the smaller time frames. So looking at this on a 15-minute time frame. So hopefully we've done the analysis already. We can agree that this is, roughly speaking, a level of support and resistance. Let me show it to you in a little bit more detail. We've got sort of 25 minutes before we start seeing some US capital come into these markets. So what we're looking for is support and resistance, strong levels of support until we get that breakthrough trade, and then when we're down at these lows, we'd expect pullback in and around this kind of area. The fact that it breaks a little bit higher is really null and void. This is such a capitalized market, and we're talking about 7 or 8 pips. So really from here to here effectively means nothing in markets this big. So and what we can see is we're currently just experiencing a pullback on a 15-minute time frame. So it's not insequential. It's actually it's an important time frame. And all we're simply seeing up at this strong level is a pullback off the high. So for that reason, what we want to see is the market fail to make a new high. And if that's the case, then we can identify, strong levels. This is a structural failure trade back to the downside. And that's what we need to wait for. And this is why patience becomes quite important for traders, because we want to read these markets like we're reading a book, and we just want to sort of ponder on what's likely to happen next. And for us, we're still, on this little path to the upside for the euro dollar. So we don't want to get in the way of that potential move if that's what happens, and we get this market just making a new high, and it'll be very much in keeping with what this market pushing to the upside. So this trade is potentially still on. So because we want to trade what we see, not what we think. We don't think that we've got an automatic right to just start selling this market. It's actually just pulling back off the highs. Now we want that structural failure trade, and this is just us being consistent in our decision making, and that's what allows us to generate consistent returns. If we're 1 minute selling these little sort of pullback trades off the highs, and then next minute waiting for the structural failure and things like that, then there's a lot of inconsistency can creep in, and we start losing traders and things like that. So for that high probability trade, and that's really what we should be looking to do when we trade markets, is to have something that keeps you as objective as you can trading, and that's the structural failure trade. That's what this information can give us. So so that's our approach. We're actually waiting for a structural failure trade to the downside. So so let me just put these charts up. There was one more chart there actually, which was the pound yen. So the equity markets are continuing their move to the upside. So yesterday we were looking for this market to, this is from our trade plan webinar. Every night at 9 o'clock we go through these opportunities well in advance, so when we get to our trading desks in the morning we can look for those opportunities. And it's the 150.70 level to the upside for the pound yen, and you can see we're actually above that as things currently stand. We've had a nice move to the upside, so we might be able to get involved in this on the pullback. We'll see kind of where we're at. So actually we could extend a little bit lower, and if we're trading support and resistance, this is the level at which we want this market to actually come back to. And if we get some indecision down at these levels, then there's your potential buy trade. So actually, although it looks like we're quite close, we're really not too far. We're probably only 5 or 6 pips away from making that touch and making it a strong level of support down at these lows. We might get there pretty soon, and it might give us a decent buy opportunity in the pound yen. So again, we can't sort of stress how important it is actually to be able to plan your trades in advance of them happening. It really does help. So let's go ahead and I'm going to just amend these trades just prior to the US Open. So we'll be ready for an influx of capital if that's the case. So for this trading session, we're actually looking for so we're actually looking for a structural failure trade to the downside, and we'll discuss what that looks like in just a moment. So we want this market to actually push higher for a short period of time, fail to make a new high, and then collapse to the downside, and then that's our green light to be able to get into a trade like this. So looking for a structural failure trade to the downside. So we can just keep an eye on this little box on the screen, and I can give you a heads up when the opportunity is primed. You know, markets spend an awful lot of time getting themselves into positions where, you know, they can become where we can actually get quite active with them. So as you can imagine, this is why patience is really an important part for traders. There'll be a lot of traders trading this little move, perhaps for reasons that they don't quite understand. It's just like selling the high or buying the low, and that in itself, you might find it's just it's a tough place to be on a consistent basis, because your trade frequency has to be that much higher, your win rate has to be quite high, and you're obviously going against the commitment of others, which is something that we focus on. We want to know where the capital is moving, what direction it's moving in, which markets they happen to be moving in, and we want to trade that information. So horses for courses, there is a lot of ways to trade these markets profitably. We just want to do so in a very, I suppose, consistent and disciplined manner, and we think that will allow you to be consistently profitable, not just now, but of course, you know, for years to come. It's an approach that you can adopt for longevity. We're not boom and bust traders. We want to see nice consistent returns, and we're very comfortable with that. We do see an awful lot of other educators that will go for that boom and bust type trading scenario, and that's great if you're on the boom side. It's very damaging and a very difficult place to be if you're on the bust side of that equation. So there is a methodology that you can adopt, that you can apply, that can be consistent, that you can look for these opportunities. We can see what's going on in this world, and we can position ourselves accordingly for those moves. You know, which is exactly what investors do. It's what they're supposed to be doing, and we want to piggyback on the profits of others, and find out who is committed to these markets. Are the buyers in control? Are the sellers in control? And then we can make decisions accordingly. Okay, so that's the euro dollar. We're waiting for that structural failure trade to the downside. So currently it's just a pullback off the high. So actually, we can look for that structural failure trade to the upside as well. We've had this little market just bounce off that. There's very little liquidity in these levels. You know, we're talking about 10 pips. This market has moved about 10 pips in the last hour and 15. So really not that much volatility in this market, as you can see. So what we can simply do with this trade is look to So what we're looking to do is to buy a structural failure to the upside. So this is the opposite really of the euro-dollar trade, where we want this market to actually squeeze a little bit lower short term and then some volume coming into the market to the upside. So we'll see if we get that trade. We can just monitor and track. I'll just take that off screen because that's not too relevant. So we can see if the dollar is strengthening across the board, and we can see just mildly that that's the case. We're still 15 minutes away from US traders entering this market. So the gold market is quite an interesting trade. So we're in that potential really to look to sell this market. We are straddling the monthly low, so putting a stop loss above the high wouldn't be a bad idea. So the 1705, you could have a sort of a 1725, so about a $20 stop loss perhaps on this trade, and there is probably a $30 gain just down to these levels, the 1678 level. So we certainly don't believe that this dollar trade is finished just yet. Now if situations change, then we can change our bias. So we're still looking for that dollar strength trade, and we'll see if we get those opportunities or not. So and don't forget, we will be going into these once we get a bit of a heads up. So we're looking for these structural failure trades. You know, we can see when a bit of buying comes in. We can go down actually into the smaller time frames as well to just fine tune that entry. For now, we're just getting the dollar strength trade. Begin to filter through. So we like this market to the upside. We'd like it to bounce back to support around the 150.67. So if you get a flush lower, it might give us a decent entry at those levels. Right, let's take a look. So looking to buy at the 150.70 level, let's say. Okay, so we're looking to buy at 150.70. Yeah, it's a pullback trade at 150.70. So that just gives you a little bit of a heads up. We are looking to, in fact, let me zoom in just a fraction so you can see that level. So we just want this market to actually squeeze a little bit further to the downside. So we are just getting a bit of a squeeze. Yeah, so Finbar, really good question. When you're doing intraday trades like these, do you work off the hourly chart and take profit at the end of the day or the end of the week? Yeah, really good question. I suppose the response we give is when we look to enter a trade, it needs to meet certain criteria. So it might be we need the market to bounce back to previous support. We need to see perhaps structural failure to the upside. We need to see some momentum and volume coming into these markets. So we have criteria in which to get into a trade, and we try to use that same criteria to get out of that trade. Because what we want to do, as you know, is to look to let those winners run when we get some winning trades. We want to give them room to breathe and to see a sizable return in a relatively short period of time. That's our objective. So we use a multi-time frame approach, and that doesn't really help you too much because we don't necessarily want to be committed to any specific time frame because we're getting the overall overview from the bigger time frames. So actually what we can do is we can get a green light from the daily time frame, and the time frame that we get in the trade is normally probably between 5 and 15 minutes. That's the time that we get in, and we take a trade on that time frame. So let's say that we let me put this up just as an example. So sorry, let me give myself a little bit more room here. So let's say we get this type of price action in the euro dollar, and we see that this level just in here. So let's just say, for argument's sake, the 1885 level. So that's our entry, 1885. Okay. And then we take a structural high in here, the 1916 level. So this can be our stop loss, and let's say we're looking at 30 pips. So from a time frame perspective, we may very well decide to get into this trade. We know exactly what's going to happen on the bigger time frames. However, we might sort of work with the 5 minute time frame to just sort of fine tune it, maybe get in a little bit closer to the 1890. And on rare occasions, if we want to be sort of super critical of this trade, we'd be looking to we could even get in on the 1 minute time frame, but we will then sort of zoom out if we can't see a clearly defined stop loss on the minute time frame or the 15. We look for the hourly level. So we're constantly going through different time frames, if that makes any sense to you. And do we take profit at the end of the day or at the end of the week? Yeah, so we've got sort of I suppose a weekly target that we aim for. So yes, we do quite often take our profits towards the end of the week, depending what's go on. But we also look to carry 1 or 2 trades over. So if we can make profit and carry 1 or 2 over, then that's probably great. From September through to January, because of the market conditions, we would carry very little trades over the weekend, and in fact our trade frequency was very, very low indeed, because of the market conditions, because of the lack of clarity actually in some of those trades. So from a time frame perspective, we use multi-time frame analysis, taking our decisions from actually the bigger time frames, like the daily, and then we just go down the smaller time frames to just fine tune the entry, fine tune the stop loss, and if we can't get our stop loss on the smaller levels, then we'll look at the 15 minute or the hourly, to just identify a clearly defined technical level in terms of stop loss placement. And yes, largely we will look to secure profit on a weekly basis. We do have a kind of a weekly target that we work towards, and but what we try to do is, if we can book in profit, if we can get ourselves into zero risk trading opportunities with some other trades, we might look to let them run into the following week. So that doesn't answer your question brilliantly, because it is quite a fluid thing. So we're not that stuck to any particular time frame, and we've got freedom to take profits whenever the opportunities present themselves. And if we can if we can hit our target on a weekly basis and then carry trades over, then that's probably an ideal, and we can mitigate risk on those profitable trades. So it's actually just putting all of these things together. So does that help at all? Does that sort of answer your question? Yeah, just it's like trading for us is a skill that you can learn, and we think anyone can learn it. That's why we talk an awful lot about be consistent in the trades you look for, and know the market conditions. So if you're in a sideways moving market, and markets are clearly consolidating, and you get into a breakout trade within that consolidation, and you're wanting a sizable return, then the likelihood of that outcome is very, very low, because markets are clearly consolidating. So it's kind of making, I suppose, very common sense decisions, really. Now, if you said to me, this market is consolidating, and I'm looking to buy the breakout to the upside of that consolidation, and I expect a 2, 3, 4, 5 times your risk, then that's absolutely viable. And then you give that trade as much opportunity to the upside as you can, mitigate risk when you can, and then that makes sense. That then becomes a higher probability trade, and you don't really need to complicate it any more than that. And I appreciate trading is a difficult skill. There is this. You do need to have a baseline knowledge and understanding in terms of why markets move the way that they move. That's why we have our live trade rooms every evening, so that we can discuss the fundamentals, we can prepare ourselves for the moves the following day. And you're quite right. It is, I suppose, practicing the skill. There's no substitute to live trading. There really isn't. People really want to use demo platforms, and although that can give you a little bit of execution experience over the short term, it doesn't help you be able to make money out of trading markets. So applying what you're learning in a live dynamic environment with reduced risk, actually, taking risk out of the equation, or taking big risk out of the equation, is a really important part of all of this, because if you can't deal with the psychology of the weight of the trade, then you won't make the right decisions anyway. So take that risk out of the equation, and you will probably be able to think with a bit of clarity. Just trade support and resistance and Japanese candlesticks, and make fairly straightforward, common sense decisions. We don't want to be too clever about these markets, because they will always do their own thing. So what we can do is we can focus on our approach. We can focus on how much capital we're committing to a trade. We can focus on which markets we look at. We can focus on where we enter. We can focus on where we place our stop loss. And we can keep our feet on the ground, whether we take a series of winning trades or losing trades. You know, trading, you know, we want to have longevity in trading markets. We never get ourselves into a situation where we blow up, you know, 60, 70, 80% of our account. That's never ever happened to us. And we teach traders obviously how to survive long enough to be able to learn how to trade. And you know, we can provide traders with that level of support on a daily basis. Like, the daily mentorship is really quite important, and we'll try and keep you on the right side of these markets. But sometimes it just gets really choppy and really difficult for even you know, profitable traders. You know, we definitely go through some hairy market conditions, and you know, you've got to keep your powder dry during conditions like that, because they are erratic. They don't need to make sense. You do scratch your head and you know, look at price action, and you know, really sort of question, you know, like, what's going on in these markets. The case in point, and I'll put a question out there. You know, how much confidence do you have in the US equity markets that this market is going to push to the upside? Just by looking at this price action. In fact, this level probably isn't drawn that well. So we've got this mildly bearish market condition. We're trading inside yesterday's highs and lows. We don't really have much volatility to the upside, so the pace and the strength of the buyers, you know, is fairly weak. Of course, if we start seeing prices break above these levels, then we can expect prices to push up. But we're still inside, you know, a strong kind of danger zone, and all you need is this bond, US Treasury bond auction, to just push yields higher, and you'll see these markets roll back over to the downside. So are we bullish of these markets just because we've got a bit of bullish price action today? The answer is no. And so really, Finbar, there's no other alternative but experience these markets and take the risk element of trading out of the equation when you're first starting out. If you're oversizing and you're trading a percentage of your accounts, like we see traders, or we do trade analysis on traders that take 10, 15, 20% risk on a trade. The problem with that is 3, 4, 5 losing trades and your account is burned. So that's the opposite of stacking odds in your favor when you trade. That's just gambling and just reckless decision making. So the problem with that is someone could be lucky, like going into a casino and putting, you know, 10 grand on black. You might win and double your money and think you're a genius. The next night you might go in with that 20 grand that you've made and put it all on red and lose. So it's that boom and bust type trading environment that really, that's for, and don't get me wrong, there's a large percentage of retail traders that trade exactly like that. They want to get in to make, you know, a lot of money very, very quickly, and very rarely will a trader that adopts that approach come out on top. Now the difficulty is 1 in 100 might do that, and 1 in 100 might then put together some YouTube videos to tell you how good they are at trading. And lo and behold, you very well may get induced by that and think that that could be replicated very, very easily, and suddenly find out, actually, you know, it didn't quite work out for me the way that it worked out for this guy. And that's just assuming that what you're seeing from the evidence that they provide is legitimate. Because quite often, and I know for a fact, you know, it's not necessarily that legitimate. People they now find ways to kind of fraudulently, you know, show proof that can be put together with someone that's just got a basic understanding of how to do those things. So that's a problem. You know, you may have heard in the press over the last sort of 12 months that you know, there's lots of retail traders plowing into this environment, and the answer is yes, there is, but there's an awful lot of them that are losing an absolute fortune. We know a few examples ourselves of people that did just that. But then for every 100 that take big losses, there'll be 1 or 2 that very well may, you know, buy Bitcoin at $10,000 and now they're up, you know, $50, $60, $60,000. So there's I suppose that's the nature of financial markets, really. But there's no substitute for kind of knowledge and understanding and being able to practice with live capital, which is really the point that, you know, you've emphasized there is practicing these principles and approaches is an important tool. And over time, what we find is we traders, profitable traders, get an opportunity to develop their approach that they're comfortable with, that might be a slight deviation from what we do, which is fine. They might integrate certain indicators which make them feel more confident about those trading decisions. All of that is absolutely fine. Really, our approach in terms of educating traders is to, I suppose, develop a strategy and approach that is meaningful to them, that will give them a little bit of an edge in this market. And if they can apply it consistently with discipline, give themselves a bit of time to actually, you know, learn how to make consistent returns and get into the habit of seeing winning trades. You know, that's so important. Yes, avoid taking losses. Yes, absolutely, that's first. Avoid taking losses. If you don't need to take a loss, you know, try to avoid it if you possibly can. And that's an important part of trading financial markets. Avoid those losses wherever possible. But then the focus starts to shift to profits. And for us, we don't want to limit our profits. We want to basically try to let those winners go. Sometimes we get a series of back-to-back winning trades. You know, and you can see a nice sizable return in your trading account, again in a relatively quick fashion, quick manner. And other times it can be a little bit more challenging and a little bit more difficult. So this is the so now we're now in the US. We're hitting the trading open. So really, looking at a market like the euro dollar to the upside. Apologies there, Finbar, if I kind of went off on a bit of a tangent on that one. We've got the pullback from the highs, okay? So this is tick 1. So now we're seeing some momentum come back into the upside. So the psychology of this market is such that if we break above the 1916, then we can absolutely expect prices to continue higher. But we're not looking for that buy trade. We're actually looking for the sell trade. So, and this is what I mean, have a directional bias. Know if you're looking to buy or sell. We're not looking to do both. We're looking to do one or the other. So what we would like to see is this market just extend perhaps up to here, somewhere like that. And then we'd like to see this market actually roll back over to the downside. There's your structural, looking for a structural failure trade to the downside. That's exactly what this means. And that keeps us objective. You know, otherwise you're struggling to know, oh, shall I get in? Am I just going to sell the highs? Is that the type of trader you want to be? Or shall I wait to see something that I can actually work with, that I can see, that I can identify, that I can, you know, look to take the clever trade. So actually we want this market to push higher a little bit more over the next 2 or 3 candlesticks maybe, and then we want to see it roll over to the downside. So it just means we need to be a little bit patient for the trade. And then the beauty becomes, so if this is a strong level, we've already discussed this is a strong level of resistance in here. We can take this high in here, and if we get this little move to the upside, you see it all the time. That reversal trade is your sell trade, which is what we're looking for. You've got a nice 30 pip stop loss, with plenty sort of 2 times our risk on that trade at least. So let's see these lows. So we can actually record these lows down here, which is the 1834, looking to get in at the 18, let's say 80, with a 30 pip stop loss. So 50. So if this market just breaks the low, the 1820 levels, somewhere around that, then that will be a positive 2 to 1 return on this trade. Absolutely quite possible. We just have to give it time. So to answer your question, would we take profit on this trade today? No, we wouldn't. We'd need to see this market actually roll over below the 1834, and then we might look to get it to take those profits at lower levels. So I hope that makes a little bit of sense. On the daily time frame, you just see the just roll over just from those highs, and that's fine. That's kind of what we'd want to see. Just to compare and contrast really between the 15-minute and like the 5-minute, because there might be some concerns in terms of, you know, what time frame should we trade. This would just give us a quicker entry. You know, we'd be able to obviously maybe get into this in the next sort of 2 or 3 candlesticks, which could be, you know, 10-15 minutes. We could be able to pull the trigger on this trade. 15-minute, you'd have to see a different type of setup, and then 1 minute just goes in even more. One of the reasons why we don't trade 1 minute time frames is due to the automated trading bots that are out there. Have a look at that. Okay. So we prefer to, unless we've got a really strong level that we really want to get into it. Let's say the 1880 level. If we just mark this low down here and say we really want to get in as close as we can to the 1887, then we can get into it on the 1 minute time frame, maybe a close below that 1 minute time frame. If you had to wait for 15 minutes for that close, you know, the price could be, you know, down at the 1860 level. So it's always a trade-off. And for us, it's multi-time frame. It's looking across different time frames. If we know what we want to see happen, we can go to lower time frames to get into that trade. And if things don't add up and don't look right, we generally sit on our hands. So that's where the patience come in. See, this is quite a shallow pullback. You know, if we had a nice solid pullback up to these levels, you know, that's quite a deep pullback. And if we get this extended move to the downside and we get in around this sort of price in here, you know, we've got our stop loss. This market will have to trade through two structural highs to actually stop us out. So again, you're just putting barriers and you're just stacking the odds in your favor as much as you possibly can. So we're beginning to see the potential for this euro dollar to just continue to just roll over to the downside. It just remains to be seen whether that's going to happen or not. So now we can probably monitor this market on a 15-minute time frame. So it's the opposite that we want to see for the dollar yen. So we want to see this market just roll over, make a higher low in this case, and then see that little structural failure trade to the upside. So at the moment, the markets are giving us a potential opportunity to sell the euro dollar to the downside below that 1887 level. The Swiss franc is just pulling back off its highs still. So again, you need that structural failure, that rollover trade. It is finding, it's important to note, we are finding some resistance, which is now support. So you'd expect prices to push higher and then take that turn to the downside. So in and around this level in here, the 93 cent level could be a decent opportunity to sell at the dollar Swiss. It really does depend on our conviction for the dollar strength trade, which is still, we do have a strong conviction in that trade, and if we're correct, we should see a nice sizable return across, you know, a number of our trades. So the markets are clearly dealing with a bit of a question mark, really, aren't they? They're just, the euro might be the start of that trade. The S&P's rolling over, so maybe it's the beginning of that sort of stock market sell-off, dollar strength trade beginning to kick back in again. So we might be able to, and so we can suggest that there is a potential sell trade at these current levels for the euro dollar. Likely to run into a little bit of support down at these lower levels. So okay, let's get into this. We're already in this euro dollar trade to the downside, but we're going to add to this trade, and it looks like we're just going to get the close. So we're getting some action now in this trade. Just look at it on the 1 minute. So this is how we're using the 1 minute time frame. Let's see the close. So we've got 2 minutes towards the close. We want to see this market stay below the 1887. If that's the case and we get follow through, we're in on the trade. So it's a constant checklist. It's a constant sort of looking at the opportunity and saying, right, well, we want to see X, Y, and Z before we get in, and then we're going to look to get into the trade. So we want it to close below the level. So that's criteria number one. and then we want to see follow through and continuation. So looking at this on the so we got the close on the 1 minute time frame below that level, and now we got the continuation trade. So we can keep an eye out, because when you get close to a higher time frame, it gives you a slightly better overview. So what we're seeing now in this trade, and I'll get the deal ticket up just in case we end up getting into it, is momentum further to the downside. So our stop loss is the 19, so it's 119.15 plus 4 pips to the upside. 119.19 is our precise stop loss, and our entry looks like it's the 1884 level. So that's a 33 pip stop loss. So you just get the deal ticket ready to pull the trigger, and if prices come back above the 1887, then that's not what we want to see. Okay, so we're close to pulling the trigger really for this euro dollar sell trade, and you just want it to act as per expectations. So now as it's rolling lower, you'd want to see this level just maintain itself. Which it has done. So see if we start rolling lower, we can get into that trade. You can have a quick look at it on the 1 minute. We just had that little impulsive move up to the side, up to the upside, and now it just looks like it's rolling lower. So let's see if that's the case. I suppose it can be quite disorientating flicking from time frames, and maybe that's what confuses traders a little bit. But you definitely get a lot more used to it. So now we're just flushing to the downside. I'm just looking at the equity markets. I'll bring it up on screen in just a second. So we just want to see this market close below these lows. So we're a few seconds away from the close in the 5-minute time frame, and so now if we're looking at this, we've actually got a potential structural failure back to the upside on the 1-minute time frame. So if that happens and we're back above this level in here, then we might have to hold off getting into the trade. If we can close below this level, then we can get into the downside. So it looks like this level is holding, which is what you'd want to see. Now we're getting that flush to the downside. So this is going to be our second trade in this market. Just want it to close there, and then we can get into that trade. So close now in just a couple of seconds. Just have a look and see what it looks like on the 5-minute. And you'll see this market close now in a couple of seconds. Okay, so we don't want to get into the kind of the grind. We want to let the trade play itself out. We've just got this momentum low, and it's the 1884 level. So you've got that 1880 level, which is the 80s and 20 levels, which can provide a bit of support and resistance. So that's the only reason why sort of just holding off just a fraction. Okay. Just holding off just a fraction, isn't it? So now, unfortunately, on the 5-minute time frame, this is now a rejection of the downside. And if it reverses back above the 1887, so we are technical traders, so we get in and out technically, and there's things that we want to see happen in these markets, and we teach our traders how to do that. And there's two things when we get into a trade. We want to see levels broken with volume and momentum. So that's absolutely the case. So we saw a nice little explosive move to the downside. The second part of that equation is follow through and momentum. And just at the moment, we've just got a question mark on the follow-through trade to the downside. So just on a 5-minute time frame, and the higher the time frame, the more reliable the price action becomes. we can see, so if we take candlestick 1, 2, and then 3, if we just focus on what's happening with these 3 candlesticks, what we can see is we've had the break of this level, so that's so far so good. Looking at candlestick 2, we've actually got a bullish candlestick, so that's not that good. And now we're needing to see, can we actually close below that 1884 level? This level just low in here. Can this market close below that level? If we close below the level, we're off to the downside. If it stays above it, we need to practice a little bit of patience really with the trade. So you're wanting to see that momentum follow through. So it's really just creating a bit of a floor. This is 15-20 minutes now of just sideways moving price action at this price. And all this does is give opportunities to buyers to actually come in and start buying at these levels. So look, there's clearly a little bit of support in here now at this price. Now, very likely to kind of flush through, and we've not broken back above the 1887. So it's just a little bit of up and down, probably before we get the flush trade to the downside, which we can hopefully get into now just very shortly. I do apologize. We do need to end this broadcast in just a few minutes. Okay, so on the 5-minute chart, we're actually now breaking above that 1887. That's what it looks like on the bigger time frame. So it is a potential level of support in at this price. So is there the conviction that we would be looking for? That is the question. So I'd hope you'd agree when you look at this price action is that it's just consolidating. We've just run into a period of consolidation on the smaller time frames. So that's what this represents. And you know, that's fine as well. All we can do is get in on the flush trade to the downside. So if that's the case, there might be a sell trade around the 1880 level. And another reason why that's fine is because you're putting floors and ceilings in the way. So when we get taken out of a trade, at the very minimum, we want the trade to work really, really hard to take us out. And if you have, you know, a bit of a floor and ceiling created here, and then you get that flush trade, you know, what you're doing is you're creating levels in this market to get stopped out. So you're putting, if you have your stop loss up here, you'll have this level, this high, to, let's say if we move sideways for a period, you got 3, and then you might have other levels down here, for example, you know, to actually provide resistance if prices start to reverse and push higher. And that's what you really want to do. You want to try and build in as many levels between your entry and your stop loss as you possibly can, and that takes a bit of time to evolve. Okay, so look, I do apologize, we do need to shoot off. We've got trading sessions with other traders, so happy to run these webinars absolutely live. Any further questions, feel free to post them into the chat box. You can clearly see we need to just just be patient really during this zone. If we break below the 1882, we can absolutely get in it to the downside, and if we can't break below that level, then we stay out of the trade. And it's probably as straightforward as that. On the 15-minute time frame, we're finding a little bit of support here, but it's that rollover trade we're still looking to get involved with. But at the moment, we're just, and this is it on the 15-minute time frame. Are we getting the follow through? We got the breakout trade. Are we getting the follow through? The answer is no. Right now the answer is no. And if that changes, we can sell it. And if it doesn't change it, then we can't, of course. Okay, so we're looking for that structural failure trade in the euro dollar. We want the dollar yen to perhaps sell off a little bit and then see the next leg to the upside. Same situation for the dollar CAD. Maybe a bit of dollar buying, fail to make a new low, and then get in on the buy trade with the dollar CAD. Yeah, the major level for the New Zealand dollar is actually below that 1790 level, and as you can see, we're kind of trading above that. So maybe tomorrow there'll be some good opportunities in there. Gold is still trading pretty close to these levels of resistance. So this is on an hourly. So have a look at this. This is a good example. You know, this is potentially the beginning of your structural failure trade. So will we close and break above these highs? If not, this is the beginning of the turnaround. So this will then become a high, this will become a lower high, and we'll and all we're doing is trading price action. We're understanding the fundamentals. We know that the dollar's been strong recently. The gold price is crossed with the US dollar, so if the dollar's strong, it's likely to push pressure to the gold markets to the downside. And you can see all of these levels just sitting in here. Okay. So we might get that rollover trade in this market pretty soon. And then the S&P, there's that little rollover trade for the S&P. So it's taking a little bit of wind out of its sails. You know, we spent all morning struggling to break higher, and now it looks like we could be back onto the downside, but there's a lot of sort of levels of support and resistance in here. So a bit of a question mark, probably a little bit more up and down price action in the short term for the S&P 500. And just lastly, the pound yen. We're seeing this market just make a little move to the upside. There's still lots of resistance at the highs, and we would still like to get into this around the 150.70 level. So we'll see if that opportunity presents itself or not. So on that note, thank you very much for joining us as always. Sorry, we do need to cut it short at this point, but if you do want to garner some more support in trading these markets, and I suppose being well informed and looking to stack the odds in your favor, then of course we can assist you with that. So just go to a website there and on the screen, www.thelivetraderoom.com. You can feel free to speak to us through the chat function. We can tell you what we can do, and we offer a whole range of support services for traders, all at very, very low prices. So go and have a look, and if we can be of assistance to you, and then that will be fantastic. We trade our own capital, so we make enough out of these markets, and we want to bring something that's transparent and fairly straightforward to traders, and give people a genuine trading environment in which to learn. Okay, so on that note, thank you very much for joining us as always. We'll be back online again tomorrow daytime at 12 noon. So from everyone here, take care and we'll speak to you soon. Bye for now.